Hello everyone, how are you? I'm Dr. Labib. I hope you are doing well. Preparations are going on for the final examination on. Okay. Today we are going to start a new series. Okay. Related to mock examinations. Okay. I have taken this mock exam from one of the learning providers examination kit. And this is not my examination. I have taken it from the book, and I will explain you. Okay, and we are going to have as simple as that financial reporting, and based on that we will first we will do section A, section B, and section C. It is a series. Okay, first I will do section A, then next section B, then next section C. Okay, I kindly request you all, please subscribe to this channel, share this channel, and press bell icon so that you will get notifications as and when I post my videos. And share this channel to the extent possible, and whatever your comments is there, please mention where it can be improved and how best we can reach to the people as such. Okay, F7 financial reporting, F8 audit and assurance, SBR strategic business reporting. Okay, and inshallah next exam we will have financial management and advanced financial management. Okay, come back to this. Fine. What we are doing, we are going to have the section A, section B, and section C. Okay, this session we will have section A. Section A will have 15 questions, all MCQs with calculations, with calculations as such, and conceptual questions will be there more or less, is it? It will be based on what? It will be based on the concepts. Fine, basically concepts and principles. We can put it like this, principles. Fine. Now we will do section A, whereas section B is scenario based questions. See the things. They have made it very clear. These are all compulsory and it must be attempted. Fine. All are compulsory. There is no choice will be there, and you need to attempt it. And we take care carefully. The way most important is you understand it. You see the way how we have to work out the multiple choice question, and we have to interpret all four options. If options are given, don't make sure that we got the answer and we can skip other options. That should not be done. Even we get the first A is option is correct, but even that, just go through B, C, and D so that you will have clarity on that, because it consists of 2 marks. Okay, consists of 2 marks, very crucial. Each question will have 2 marks, means you can understand how much we have to think about it. Fine. Next, coming back to this, it is in section A. Okay, in section A they will give you 15 questions. Okay, they will give you 15 questions, and in the 15 questions all are independent. Okay, all are there is nothing like we are going to have 2 or 3 questions linked to that. Nothing is there. So all are independent questions. One by one we will do. Okay, the same process I will do. I will explain you all the options. Okay, it says that which of the following, each question is how many marks? 2 marks, worth 2 marks. And ACCA is examination where each mark is important. Each mark, as a matter of fact. Which of the following should be capitalized in the initial carrying amount of the plan? Whenever we purchase, whenever we purchase an asset, okay, whenever we purchase an asset, there are 2 things. One is pre-operative, one is post-operative. Okay, one is pre-operative. Pre-operative things has to be capitalized, and it is shown in the statement of financial position. Whereas in terms of post operative, it has to be what? It has to be shown as a expenses in the income statement or profit and loss account. Fine. That is the basic thing when we are talking about the why we have to capitalize pre-operative, before operation, any expenses, transportation, installation, training, any space we are using, fine, anything we have pre-operative, before it is operated. Which of the following should be capitalized? Which of the following should be capitalized and in the initial carrying amount of the item of a plant? Cost of transportation, the plant to the factory, yes, it is pre-operative. You see, it is like what? It is like carriage inwards, is it right? It is like carriage. It is like carriage inwards. It is not carriage inwards. It is similar to that. Fine, means it is there. Fine. Cost of installing a new power. You are installing a new power supply required to operate this particular plant, is right? To operate this particular plant, it is pre-operative. Fine. Now, cost of 3-year maintenance. It is maintained. It is what? Which expenses? It is post-operative. Post-operative. It is operating expenses. Fine. It comes in the income statement, operating expenses. Cost of 3-week training of course for staff to operate the thing. This is the training cost, is right? This is the training cost. Training cost to operate. This comes in what? This comes in operating expenses. The answer is what? The answer is 1 and 2. Okay, the answer is what? The answer is 1 and 2. Next, what is the same? When a parent is evaluating the assets of a potential subsidiary, certain intangible assets can be recognized separately from goodwill. Okay, this is with respect to what? This is with respect to parent company and a subsidiary company. When parent company is evaluating the assets, certain intangible assets are recognized. Okay, from goodwill, even though they have not been recognized by the subsidiary company, has not recognized, only the parent company has been recognized. Okay, own financial statement. Which of the following is an example of a intangible asset of the subsidiary? Is it? Which of the is the subsidiary which may be recognized separately from goodwill? You have to be little bit have a common. See, I have posted some lectures on consolidated financial statements. Fine, just go through that. Is it? When you have that, before doing this, anywhere any doubt is there, go through the conceptual lectures. What it says? It says that a new research project which the subsidiary has taken correctly expensed to profit and loss account, but the directors of the parent have reliably assessed to have a substantially fair value. Means subsidiary has been identified as a, see what happens, see the things again. You have research and development. Research expenses has to be expensed, and the development has to be capitalized. Is it? The development has this is the basic principles with what we are doing. A new research project which has subsidiary has correctly expensed to profit or loss, but the directors of the parent reliable. But the director says that it is a development expenditure, whereas the subsidiary says it is a research expenses. A global advertising campaign. See, advertising campaign is it is neither a research expense nor it is a capital expenditure, which was concluded in that also it happens previous financial year, from which benefits are going to expect in the future. The concept is you are giving advertisement, definitely it related to the operating expenses, selling and distribution expenses. Is that selling and distribution? It is not a, this is not a capital expenditure. Okay, no, it is not an intangible asset. A contingent asset, again, see, it is a contingent, may be or may not be, of the subsidiary which the parent believes a flow of economic benefits is possible. First, it is a contingent liability. Then, it is only an estimation. Okay, it is only an estimation. Again, we cannot say it is going to be a intangible asset. A customer list with the directors are unable to value see, when you are unable to value reliability, definitely it will be a question mark. Okay, it will be a question. The answer is what? The answer is a new research project. Coming back to the next one. On October 1st, 2004, Flash Company acquired an item of plant under a 5-year lease agreement. Fine, okay, that's good. Under the terms of condition, an immediate deposit, how much they have paid? 2 million. Inception of the lease, and the present value of the lease payments is calculated how much? 25,272,000. How much they are paying annual rent? 6 million. And are payable on 30th of September each of the 5 years. The agreement has been, they have an implicit rate of interest is how much? 5%. 5% on the outstanding amount. Okay. Or what is the current life? First you have to know the current the current year liability and the next year liability. What is the current year liability and next year liability? The difference between the current year liability and the next year liability is the difference between the current year liability and the next year liability is going to be identified as a current liability asset. We have to calculate it. Is that first we have to calculate year, then we have talking about the opening balance. Is it a opening balance? We will calculate interest at the rate of how much? Interest implicit rate is how much? 5%. Then we are talking about the annual payments. Is it? Then we are talking about the annual payment. Then we are talking about the closing balance. Fine. Now year is how much? They gave you, when they gave you the things on 30th September 2000, where it has been given there. Yeah, 1st October 2004. Is it? From 1st October 2004 to 30th September 2005. Okay, 30th September to how much is the opening balance? 25,272. Is it? 25,272. Put the columns here. Is it? This is column 1, this is column 2, this is column 3, this is column 4, and this is column 5. Okay, column 3 is nothing but what? Column 3 is column 2 times 5%. Okay, column 2 272 times 0.05, it comes to how much? 1,263,600. Okay, 1,263,600. What is column 4? Column 4 is payments. Is it? How much is the payment? They are paying 6 million. Okay, they are paying 6 million. Column 5 is 2 plus 3 minus 4. Okay, 2 plus 3 minus 4. 25,272 plus 1,263,600 minus, put it like this in brackets. Okay, now how much you'll get? 25,35,600. Fine. Next, 39 2006. Is it 13? How much is the opening balance? 25,35,600. At the rate of how much? 5% rate of interest. It comes to this much. Okay. Please check again also. Okay. You also check whether it is there or not. I have already calculated, and based on that we are working. How much is there? 15,548, 380. Okay. Now this is the difference. Whatever the difference is, it what the difference? The difference is The difference is current liability. How much is the difference? The difference is how much? The difference is 4. The difference is how much? 4,987,220. This is the current liability. How much is there? 4,987,220. Okay. Next, they are given you true and false. See, when they gave you true and false, each question is how much? Each question is going to be 0.5 marks. Okay, each question is going to be 0.5 marks. Fine. A financial statement represents transactions in words and numbers. To be useful, financial information must be represent faithfully these transactions. So they are as simple as that. We have to put it in the as per the rules and regulations, principles. Okay, we identify by selecting the relevant box in the table whether the regarding faithful representation. This is whether we have to know whether it is true or whether it is false. See, these are more crucial. Okay, true and false is, it takes really, the principles has to be very, very strong. Okay, charging the rental payments of an item of a plan to the statement of profit and loss account, where the rental agreement means you are taking the rental agreement. What you are doing? The rental agreement, we are making it in the planned and profit and loss, but actually the rental agreement lease criteria is what? Lease, and no recognition exemptions are made. See, it cannot be possible. If it is lease, it has to be related to the lease calculations. If it is for rental, it has to be related to the rental calculation. It is a false. Including a convertible loan note in equity on the basis that the holders are likely to choose. See, these are the things which you have. The moment, likely, assume, all the things. You see, you are taking a convertible loan. When it is converted, it is converted. Fine. And they have choose the option is there. There is nothing like that guaranteed that you have to convert. No, option is there. Somebody will choose, somebody will not choose that option. Okay. What they say, including a convertible loan note in equity on the basis that the holders are likely to choose the equity option on conversion. There is no guarantee that they will choose. Is that likely? The answer is false. Treating redeemable preference shares as part of equity. We cannot treat preference shares. See, I will tell you, preference shares and equity shares, conceptually lot of difference. Yeah, lot of difference. Preference shares and equity shares, there is nothing like that. You cannot treat both same. Okay, it is a false. De-recognizing factored trade receivables sold. Once it has been sold, we need to de-recognize. There is no other option. Is it right? We need to de-recognize without recourse. Is it? That is, this statement is true. Okay? This statement is true. Now, coming back to this. On October 1st, 2004, Kalatra commenced drilling from undersea field, okay, oil field. Kalatra is required to dismantle the drilling equipment at the end of 5-year license. So what is the cost? 30 million. Kalatra cost of capital is 8%, and what is the present? Oh, fine. Means we are going to dismantle the site after 5 years. How much you have to keep it as at present value? Is right? We have to calculate what? We have to calculate the present value. Fine. How much is there? It is the dismantling cost is how much? The dismantling cost is how much? 30 million. Okay. Dismantling cost is 30 million. What is the present value? 0.68. Okay. 0.68. It comes to how much? It comes to how much? 1 minute. It comes to 20,000, 20,400,000. Fine. Plus you have to add interest. Is it right? You have to add interest at the rate of how much? You have to add interest at the rate of 8%. Fine. How much will get? 2,400 into 0.08. It comes to 1,630,200. Okay. Total is how much? 22,3,012, 22,032. Okay. How much is there? 22,032. Fine. Which when a single entity makes a purchases or sales in foreign currency, it will be necessary to translate the transaction into functional currency. Fine. Before that, means we see they will give the foreign currency, right? For foreign currency, the foreign currency rates are there. When you are talking about the foreign currency, they will give what? They will give the opening rate. They will give the average. Is that they will give the closing rate, and sometimes they will give the rate in between also. Okay, in between also they will give some rates. IS 21 is that this is related to what? This is related to IS 21, the effect of changes in the foreign currency rates. Foreign currency. Which of the following currency rates may be used to translate the foreign purchase and sales? Is that purchase and sales? Purchase and sales, is it? Purchase and sales be done throughout the year, is it? Purchase and sales done throughout the year. In that case, we have to make it sure. If it either we have to take as on date, we have to take as on date, or we have to take the average. Is it right? We have to take the average. That is the concept. The rate at which exists on the day that a purchases or sale has took place. Is it right? Purchases, when it happens, you have to take that rate as such. The rate which exists at the beginning, no, it is not applicable. It's not beginning or end. Fine. It is not beginning or end. You have to take, means only it will not done at the beginning of the year. Is it right? Purchase and sales will done throughout the year. An average rate. Provided there have been no significant fluctuation. Either you have to take the date as on the date of transaction happen, or you have to take as on the average date. The rate which exists at the end of the year, we should not take. Answer is what? Answer is 1 and 3. Next. And on October 1st, 2004, Howe and Company has 2.5 million equity share capital of how much? 50 cents. Is that 2.5 million? How many shares? N will be how much? 2.50 divided by 0.5. It comes to how much? It comes to 5 million shares. Is it? No new share was issued during the year 30th September. Good. But on that day, there was a outstanding share options which have a dilutive effect equivalent to issuing how much? 1.2 million shares for no consideration. His profit after tax is how much? 1.55. In accordance to IAS 33, earning per share, what is the diluted? Once you are saying diluted, we have to do old plus we have to take new. Okay, old is how much? Existing. Is it right? Existing is how much? Existing is 5 million shares. Okay, 5 million shares. New shares are how much? New shares are 1.2 million. Okay, total is going to be how much? 6.2. Fine. What is the EPS? EPS is profit after tax divided by the revised number of shares. Is it right? Revised number of equity shares. How much is there? Profit after taxes is how much? 1550. 1 divided by 6,200. It comes to how much? It comes to how much? It comes to 0.25. Okay. Next, what they say. Fork owns 80% of the. See what is the fork? This is the spoon. Okay. Fork and spoon. How much is there? 80%. Several years ago, the goodwill on acquisition is how much? 1674, and there has been no impairment. Fine. On 30th September, Fork disposed its entire investment in spoon. Details are they have sold the investment in the spoon. How much is there? 80%. Sale proceeds are this much. For cost is this much. Immediately before the disposal, the consolidated financial statements of Fork included in the following state amounts in respect of spoon. Carrying amount of net assets excluding goodwill is this much. Carrying amount of NCI is 900. What is the profit or loss on disposal before tax with respect to consolidated profit and loss account as on 30th September 2004? We have to calculate what is the sale proceeds. What is the sale proceeds? Sale proceeds are how much? Sale proceeds are in thousands. Okay, it is in thousands. Sale proceeds are how much? Sale proceeds are 5580. Okay, sale proceeds are how much? 5580. Now from that, what we have to take? We have to take net assets at disposal. At that of disposal, how much? Net assets are how much? 4464. Is it 4464? How much we have to add? Goodwill. Is it right? Goodwill is how much? Goodwill valued at how much? The goodwill on acquisition. Is right? Goodwill on acquisition. How much? 1674. Okay. Next, you have to take out what? You have to take the NCI, carrying value of NCI. Is it? Carrying value of NCI. Okay. How much is the carrying amount of NCI? Carrying amount of NCI is 900. If you take that into consideration, it comes to how much? 5238. Okay. Again, you do calculations. Fine. 342. Is it? This is profit on sale of spoons investment. In thousands. Okay. This is in thousands. This is in thousands. How much is there? This is the answer. Consolidated financial statements are presented on the basis that the companies within the group are treated as they are good. This is the basic principle. Which two of the following are requirements of preparing consolidated financial statements? Right? All subsidiaries must adopt the accounting policies of the parent. No, they should know. There is no hard and fast rule in their individual. They see every company. See every entity. Is it right? Every entity that is a subsidiary will have its own policies. Okay. We cannot dictate that you have to adopt some particular thing. Is it right? We should not have uniformity. No. Activities will be substantially different to the activities of other members of the group. Why we should not consolidate it? See, there is no differentiation that subsidiary has to be like this. No, irrespective of whichever activity they are doing. See, you see Tesla. Tesla is doing vertical as well as horizontal. Is it right? You have every company will do that. Is it? They will have a vertical. They will have a horizontal, and there is no condition that you have to do the similar activities as such. It is also wrong. See, now what happens? We are talking about 2. Okay. In spite of that, just go through it. All entity financial statements within the group should normally be prepared to the same accounting year prior to consolidate. Yes, fine. That if you have a similar, what will happen? There will be a consistency, and it will help us to make a comparison. Okay, it will make us to make a comparison. Unrealized profit within the group must be that is what we are saying. Profit, a portion of unrealized profit. Is it right? Portion of unrealized profit. Again, when I am doing Again, a consolidated statement, I will tell you, is it? This has to be done. What is the answers? Answers is C and D. Now, dashing group, is it? See, dashing group, the dashing group owns how much? Owns on the dancer group, okay? Dancer group. It is how much? 80%. And during the financial year, some of which remains in inventory at the year end. Now, they sell goods to its 80% owned subsidiary. 80% owned subsidiary. During the some goods are less. What is it? What we are doing? We are reducing the profits. Is it right? We are reducing the unrealized profit. What happens if profits debit all expenses and losses, credit all incomes and gains. Now what you are doing? We are reversing. Is it? When we are reversing, profit will be debited. Is it? And you have to reduce the inventory also. Correct? Inventory has to be credited. Why profit is debited? You are reducing the profit, okay? Unrealized profit, and inventory has to be reduced. Is right? It is consolidation. There will not be two different inventories. All the same. You will have one amount of inventory. What we have to do? We have to debit what? We have to debit what? Group retain earnings. Is it? Group, and we have to credit what? We have to credit inventory. Fine. Now, Caddy acquired 240,000 shares of Amble. Is it right? How much? 240 immediately. You have to do. Is it 240 divided by 800,000? It comes to how much? 30%. Means if what will happen? It will be going to be identified as an associate. Okay. Immediately, you should not waste time. Okay. How much? At the rate of 6 per share. Amble's profit for the year ended is 400,000, and they have paid equity dividends of 150. On the assumption that Amble has an associate of Caddy, what would be the carrying amount of the investment in Amble in the consolidated? We have to calculate the carrying amount of the investment as such. What is the cost of investment? Cost is how much? They have taken 240,000 shares into $6. Into $6, it comes to how much? It comes to 1440. Here you have to add the profits. Is that share of associate profit? Associate profit. How much is there? 400,000. 400,000 into 0.3. 30%. Is it right? It comes to how much? It comes to 120,000. Fine. Next, you have what we have to do. You have to. They have paid dividends. Is it dividends? Dividends received. Is it right? They have received. We have received the dividends. We have received. How much is the dividends? 150,000. 150,000 into 0.30. It comes to how much? It comes to 45,000. How much? Next. Quartile company is a jewelry retail business which can be assumed to be highly seasonal for the year ending 30th September 2000. Quartile company assessed its operating performance by comparing selected accounting ratios with those of business sector average. Fine. As provided by the agency. Assume that the business sector used by the agency is meaningful representation of quartile business. Which two of the following circumstances may invalidate? This is the key word, okay? Invalidate the comparison with those of the sector. Means what they are making a comparison, is right? They are making a comparison of quartile company with the industry. Is it right? With the industry. Means two are right and two are wrong options, okay? Which are invalidated, which is not compatible, as simple as that. Which is not, means when we are making a comparison, both the conditions for both the companies similar conditions should be there. Similar points should be assumed. You should not be inconsistent. Fine. In the current year, quartile has experienced significant rising costs. Here you are not comparing. Okay, this is not comparing as such. This is not, no way it is related to the comparison. Fine. Fine means this is not an option. The sector average was compiled from companies whose year ends are, no, when you are doing the things, we should have a very fixed, is right? We can say very straightforward there, that it has to be done on 31st July. All the companies should be on 31st July. All the companies should be on 31st August. Is that all the companies will be on 30th September? You cannot have that one company is in July, one company is in August. Because what happening? They are doing which type of business? They are doing the jewelry business. And jewelry business, what will happen? The prices will fluctuate. Okay? Fluctuate very fast. Is that? Prices fluctuate very fast as such. If that is the case, what will happen? Definitely we are not going to, there will be a differentiation will be there. So this is not validated. The sector average figures compiled from the companies, right? The sector average companies is not applicable. Fine. Quartile does not revalue its properties, but is aware that, see, everybody has to revalue, is it right? The revaluation has been done in the industry. The moment you don't revalue it, definitely what will happen? There will not be any what? This is not, is it? Means this is also invalidate, and this is also invalidate. Is it? This is also invalidate and this is also invalid. During the year, quartile discovered an error relating to the inventory count at the September 2004. This error was corrected, accounted for it in the financial statement for the. There is no relation to industry, is it right? There is no relation to industry. Fine. Now, next. Which of the following criticism does not apply to historical cost? Which does not apply, okay? When we are saying which does not apply, they are difficult to verify because transactions could happen many years ago. They contain mixed values. Some items are current values, is it? Some items which does not, this does not apply. They contain mixed values. This is not historical cost, is it right? This is not a history. Some are current values, some are out of date values. No, is right? Yeah? This criticism, this is entirely different one. They understate assets and overstate profits. Yeah? They understand. See, what will happen when we are talking about the assets are going to be on historical cost, is it right? The profits will be on the current cost. Okay? The profit will be on the current cost. They overstate gearing in the financial statement. Gearing what? Debt divided by debt plus equity. Is it right? Debt will be on the current values, is it right? Whereas equity will be on the historical values. The answer is what? The answer is they are difficult to verify because transactions could have happened many years ago. When we are having many years ago, it is with respect to what? It is with respect to historical cost. Okay? Next. The following information has been taken or calculated from Fowler's financial statement. Cash cycle. Is that what is the first you should understand? What is the cash cycle? Cash cycle is inventory days plus receivables. Is that receivables minus receivable days minus payables. Okay? Payable days. Fine. Now, we have the inventory days, inventory 6 times, is it right? If they say inventory is 6 times, what will happen? How we can calculate inventory turnover? Inventory turnover is how much? Days, is it right? In terms of days, number of days in a year, divided by times, okay, number of times. How much is there? 365 divided by 6, it comes to 61 days, okay. We don't have, see, we have, now what happened? We got how much? We got 61. How much is the days? It is 70 days, okay. 70 days, 61. We don't have receivables, okay. We don't have receivables. And now we don't have receivables, is it right? We don't have receivables. We have to calculate receivables. How much is payables? Is it? Payables is how much? What is the formula for payable? They said what? They said year-end payables. Here, year-end payables is divided by purchases, credit purchases. Is it? Times how much? Times 365. Okay, times 365. Year-end payables are how much? 230 million. Okay, 230,000. Closing is how much? 2 million. Fine. Into 365. It comes to how much? 42 days. Right? 61 plus 0 minus 42. Okay. How much we'll get? Just I'm writing here. Okay. 7. Put 70 on the right hand side. Is that? This is your receivables. Is that? This is your receivables. Now if you take receivables, what will happen? 61 minus 42 minus, you take receivables, it will become minus, okay? Minus 70. Minus receivables equal to how much? 70, 112 minus 61. 120, how much is there? 1 minute. 61 minus 42 minus 70. 61 minus 42 minus 70, it comes to how much? It comes to, receivables are how much? Receivables are 51 days. Is it? This will be minus, this will be minus. Minus get cancelled. It comes to how much? It comes to 51 days. Fine. Next. On October 1st, 2004, Pyramid acquired 80% of Square. Okay. Pyramid acquired 80% of the Square. For how many? Square 9 million equity shares at the date of acquisition. Square has an item of plant which has been fair value of how much? 3 million. Okay, fair value of 3 million in excess of the carrying amount. At the date of acquisition, it has a useful life of 5 years. Fine. Pyramid policy is to value NCI at fair value at the date of acquisition. For this purpose, Square shares are valued how much? 3.5, and the year end, Square reported a profit of how much? 8 million. See what happens, there are so many things are there. They have acquired a plant of 3 million. They have the life for 5 years. They want to value NCI at fair value. The value of the share is 3.5 and the profit is how much? 8 million. At the amount, at what amount the NCI interest in Square should be valued. Okay. Now, is it for NCI? Is it NCI at 1st October? Is it at 20 at 1st October 2004? Okay. How much is there? See the thing. How many shares they have taken? 9 million shares. Is it? How much is the percent? This NCI means this is 80%. What is the share of a subsidiary? Share of a subsidiary is only 20%. Fine. Share of subsidiary is how much? 20%. Means 9 million shares. Okay, 9 million shares. 9 million shares times, is it 0.2 times 3.5. Okay, 3.5 is the market current value. Okay, 3.5 is the current value. It comes to how much? It comes to 1.8 into 2, 3.6. 3.6 into 1.8, 1.8 million. 1.8 million into 3.5. Okay, it comes to how much? This in thousands. Okay, in thousands. Now, what you have to add? You have to add post-acquisition profits. Post-acquisition profits. How much is the total profits? Is how much? Total profits is how much? Total profits is 8 million. Fine. Total profits are 8 million. Now, what they have said? They said that they have said that it is a 3 million. And plant is how much? 3 million. Useful life is how much? 5 years. Depreciation on plant. Okay. Depreciation on plant. How much? 3 million. I am taking in thousands. Okay. Divided by 5. Is it right? Divided by 5. It comes to how much? It comes to 600. How much will come? Is it? It comes to 7,400. 7,400 into 20%. So 7,400 into 20%. 1,480. The value of NCI is how much? The value of NCI is 7,780. That's 7,780. Thousands. Okay, in thousands. How much? 7,780. Okay, are you clear about this? How we have done? Is it? This is the 15 questions in section A. Consist of both calculations and the conceptual questions. Fine. And hopefully in the next session I am going to take up the section B. Okay, I kindly request you all, for any comments, any suggestions, any doubt, just post it on the comment box, comment section. I will take that into consideration, and please share it, like it, and subscribe the channel. Very, very important. Thank you so much. Best of luck.